On July 4, 2025, the sky across America was loud with fireworks. But in Washington, the most important event of the decade was happening in total silence. With a single signature, the American government permanently changed the relationship between the state and digital money. 3 days later, the Guiding and Establishing National Innovation for U.S. Stablecoins Act became law. They called it the Genius Act. Supporters called it long overdue clarity. Critics called it surrender. And almost everyone agreed on one thing. Crypto, as it had existed for more than a decade, was over. Today is January 7th, 2026. 6 months have passed since the law took effect. The panic has faded. The headlines have moved on. And we're left with a question that still divides investors, technologists, and policymakers. Did the Genius Act finally kill crypto? Or was it the intervention that saved it? To understand where we are now, we need to remember the weeks immediately after the law was signed. The act was not subtle. At its core, it imposed strict federal standards on stablecoins, full one-to-one backing with cash or U.S. treasuries, mandatory compliance with anti-money laundering rules, and formal authorization for banks and regulated entities to issue their own digital dollars. Algorithmic stablecoins, systems that relied on code rather than reserves, were effectively pushed out of the legal U.S. market. For an industry that had spent years marketing itself as trustless, this was an existential shift. Markets reacted accordingly. Volatility spiked. Risk appetite vanished. Many smaller crypto projects lost liquidity or shut down entirely as exchanges reassessed legal exposure and compliance costs. Decentralized finance, or DeFi, was hit especially hard. When regulators made clear that financial activity touching U.S. users would need to comply with identity and reporting requirements, the gray area DeFi had lived in for years rapidly disappeared. Privacy-focused cryptocurrencies were delisted by major platforms. Anonymous participation, once a cultural cornerstone of crypto, became increasingly incompatible with regulated access. By late summer 2025, much of the mainstream financial press was ready to declare the experiment over. Crypto, they argued, had finally been absorbed or neutralized by the system it set out to replace. But while public attention focused on price charts and failed projects, something quieter was happening elsewhere. Behind closed doors, in boardrooms and regulatory meetings, large financial institutions were not retreating from blockchain technology. They were preparing to adopt it. Because while the Genius Act imposed heavy restrictions, it also did something the crypto industry had asked for, unsuccessfully, for years. It drew a clear line. For the first time, there was a defined path for legally compliant digital assets to integrate directly with the U.S. financial system. Stablecoins that met the law's requirements gained legitimacy as regulated payment instruments. Banks were explicitly permitted to issue and custody them, and institutional investors were given the regulatory certainty they required. In other words, blockchain technology wasn't banned. It was domesticated. By the fall of 2025, the tone began to change. Instead of debates about whether crypto was legal, the conversation shifted to how it could be used, safely, predictably, and at scale. Stablecoins increasingly resembled digital representations of the dollar rather than alternatives to it. Bitcoin, rather than functioning as a protest asset, began to behave more like a macro-sensitive financial instrument, influenced by interest rates, liquidity conditions, and institutional flows. What emerged was something new, or perhaps something old, rebranded, regulated finance, or RegFi. It looked like crypto on the surface: blockchains, tokens, instant settlement. But ideologically, it was almost indistinguishable from traditional finance. Identity verified, audited, insured, fully integrated with banks and payment systems. By early 2026, the crypto ecosystem had split into two distinct realities. The first is the regulated zone, where the overwhelming majority of capital now resides. This is where stablecoins are used as efficient payment rails, where institutions interact with tokenized assets, and where compliance is not optional but foundational. It works smoothly. It is boring. And for most users, it feels no different from modern digital banking. The second reality exists at the margins. This is where fully decentralized, permissionless systems continue to operate, technically intact, but economically sidelined. These networks still produce blocks, smart contracts still execute, but access is harder, liquidity is thinner, and participation carries real legal risk in many jurisdictions. The Genius Act proved two things at once. It proved that governments can effectively control the on-ramps and off-ramps, shaping how and by whom crypto is used at scale. And it proved that the underlying code is resilient. The networks didn't stop. They simply stopped mattering to the mainstream financial system. So did the Genius Act kill crypto? That depends on what crypto was supposed to be. If crypto meant a financial system fundamentally separate from the state, private, censorship-resistant, and beyond government control, then that vision is further away today than it has ever been. But if crypto means blockchain as infrastructure, programmable money, instant settlement, tokenized value, then the technology didn't just survive. It was absorbed. 6 months later, the verdict is clear. Crypto didn't overthrow the system. It didn't replace the dollar. It didn't escape regulation. Instead, it won the technological battle by surrendering the ideological one. Crypto is no longer the alternative. It is simply the system itself.